I'm Ben. I'm a colleague of Sagar and Wolfgang and Marcel, Blockchain Founders Capital. And we already had the chance to talk a lot about regulation and about different aspects of technology. And I have the honor to host the last panel of our today's session, which is more about the investor and startup landscape of Web3 as of today. And we have 4 esteemed panelists who joined the discussion today, 3 seasoned fund managers and 1 founder. It's a little bit unequal balance, but you have to make up for the startup side. And
leave it to me. I'm excited.
Exactly. So let's start with, first of all, we have Ashok. He comes here on behalf of, we originally had invited Pranav from Woodstock Capital. He couldn't make it, unfortunately, on short notice. So Ashok was kind enough to chip in for him. Thanks a lot. He also works with Pranav as he's an active advisor at Agna in institutional fund of funds. Next, we have the founder in our panel, Hoon. He was the co-founder of Asta Network, well-regarded smart contract platform in the Japanese ecosystem. Maybe it rings a bell for some of you. And he is also founder of a small indie game development studio. Next, we have Feyo from Target Global. He is actually the head of digital assets at Target Global. It's a huge fund with more than 3 billion under management in total, and he is spearheading the crypto hedge fund side, so to speak, of the fund. He is also a board member and advisor at Fortina Capital, a well-known European venture capital fund for the topic related to Web3 topics. And last but not least, we have Vineet from Dubai. He is the partner at Cypher Capital. It's a crypto fund with more than 100 million assets under management. They invest in some of the earliest stages of tokens. Many of the token names you probably will be familiar with that they have invested in sometimes in the earliest days. And yeah, that rounded up, I would suggest we start, maybe Winnie, we start with you. Maybe you can tell the audience a little bit more about what you guys do as a fund, which stages you focus on, and what are most important questions for you to decide in which companies are interesting for investments and which ones are not.
Again, as a fund, Cypher Capital is a $100 million fund. Purely crypto native. I only believe in tokens. Yeah, this is very controversial. Last year, everyone was saying it's all about equity. I said this is because SEC put up a case against Ripple. Next year, you guys will be again talking about tokens. In fact, I remember, I don't know if there's a recording here. I think on stage, I clearly said, guys, cycles keep on coming. FTXs and Mt. Goxes keep on dying. But you have to understand that Bitcoin has some use case. That use case doesn't go, the markets will go back up. When people in Latin America and when people in Africa start understanding what value USDT gets to the market, this will go back up, you know. And, you know, people were saying, like, I've heard it from the morning that SEC and, you know, these ETFs going on. Guys, I would love that US keeps out of it because, you know, every time they sneeze, the whole world catches a cold. So I would love actual use case countries to get on board with these things. Highly controversial views, but yeah, that's my view. Now, when it comes to investment, you know, I think I've been a founder for 15 years. What is exactly needed is a great team. You know, ideas pivot. You know, what you start with is not sometimes what you end up with. Teams that have persistence, team that has a vision. I think backers are critical. You want backers who will be there when you are down and out. I think I've seen Yat backing his startups even in the, like I remember some of the deals that we've been part of. He's always backed them up. And there are some investors who really back them, like Sequoia does that. And there are other ones as well. So the team is important. What they're doing is important. I think the idea counts as well, you know, the clarity on how they will develop it up. Everyone wants to go to the moon, but no one has a clue how to even power up a rocket. So I look at, you know, that's where the team part comes. Do they have the capacity and the capability to do something like that? Then finally, you know, it's, I think this is what 50% of it is, and then the other 50% is the market dynamics. An amazing idea, an amazing product, and a bad market. I'm trying to be good with my words. Well, it's an amazing market, and bad market can actually make even great teams go down. So this is overall what I look at while investing.
All right. Feyo, does that resonate with your fund's thesis? Or what would you say is most important aspects about what you guys do on a day-to-day basis?
Yeah, I think we, so I run early stage liquid token fund for Target. That's a bit of a mouthful, but Similar to you, we sort of focus on tokens. We think tokens are kind of an evolution in financial instruments that kind of combine multiple asset traits into one, because essentially you have something that's digital, something that's programmable. And the other part is we, in terms of the stage of investment, we focus on, I guess our strategy is best described as liquid venture. So we work with early stage projects that, whose token is liquid. So they've typically done maybe 1 or 2 private rounds, and then they launch a token. And we like to get involved at that stage. One, because I guess often the teams are, very technically versed. But they have a token that's listed, and so they're subject to sort of public market dynamics, and they often have a lot to learn when it comes to, general sort of corporate finance, basics, and how to sort of go about, these public markets. And the other part is we think it's actually a risk-reward sweet spot, something that is new and that crypto has introduced really, because we can sort of seek venture-like returns, but with the benefit of liquidity, right? Or at least, a semblance of liquidity if you look at the stuff that we invest in. And the other part is you can track these projects, their progress in real time, right? So you're not at the mercy of, let's say, a good VP finance CFO of some, startup. You can basically interact with the smart contracts of these protocols that we invest in and pull the data in real-time basis. To answer sort of your question, I think we like to work with teams where they're at least a little bit receptive to what we have to say. My background is in TradFi, and so we from a thematic standpoint we tend to focus on infra and DeFi projects, and where these sort of early stage teams are sort of happy to listen to us, where we can say, look, if you were to guide the market on these particular KPIs, there would be a much better understanding of your product and the value accrual thereof, and therefore of the value of the overall network.
Maybe a follow-up question. Where would you make the distinction between being a crypto hedge fund and a crypto VC if you're investing in early stage projects?
Yeah, so we are a bit of a hybrid in the sense that we are, from an investment standpoint or strategy standpoint, we are more a VC. We invest for the long run. We are long only, and we want to be sort of, the capital partner for these businesses after, kind of the venture stage. After the pre-seed seed rounds, when venture capital funds not check out, but they move on to other things. We're sort of able to, kind of manage the position and help them get through, in public markets. That being said, our fund is structured like a hedge fund. So, we provide, it's an open-ended fund. You can subscribe on a monthly basis, and you will get a monthly NAV statement, something you wouldn't get in a typical, kind of a closed-end venture structure.
Cool. Hoon, for you on the founder side, in your experience, you've been involved in many different ventures. From a founder perspective, how do you choose a good investor, like besides the money, especially if you have different offers from different investors? What's important for a founder in this question?
That's a very good question. And by the way, disclaimer, guys, I've just recovered from my cold, and you know how you still have that dry cough left, so I might cough a little bit. It's also because you guys are so breathtaking. I don't have enough breath for myself. So, yeah. But anyway, in terms of investors. So I guess it also depends on the context of what kind of projects that you're raising, the nature of your project. In my case, I've done both for Aster Network, the protocol layer 1 and Polkadot, which would be naturally a token raise, and for Team Step, which is a little bit more nuanced than that, because we are creating an engagement platform for indie game studios, where we tokenize user interaction that they perform, whatever action they perform in-game or outside of the game, and just sort of connect them seamlessly. And now, the thing is, with this platform, you don't really need a cryptocurrency, at least not in the early stage. And we want to focus on the product first, value first, and then token later. And now here, the right investor becomes a problem, because as the gentleman here, both of them said, crypto is kind of king, right? Token. You invest in token, and if I say no, we're not going to do token, maybe at some point, yeah, but we feel like we should have a product first and then token later. But when the investors are saying no, we want token first, product later, then that's when it becomes a challenge. Right, so for us, we want to find an investor who really shares the mindset, not just in terms of the possibility of what that project can do, but the implication, the vision behind the team. What are they really trying to achieve through their project? Are they trying to show something that no one else have ever done before, or is it just going to be another a typical project but with a higher APR, or maybe better yields, or maybe lower transaction fees?
Understood. And Ashok, I think you're involved in the fund of funds at the moment as an advisor, but it seems like you have a very seasoned investor career as well. So where do you put yourself right now, by the way? Do you do institutional fund of funds for venture capital funds or hedge funds, or what do you spend your time on as an investor in the Web3 space right now?
First of all, I'm trying to fill in the big shoes of Pranav here, so excuse me for that. And he's also like 8 inches taller than me. I think if from the context of Agna, the focus is non-crypto. The focus is on deep tech. The core areas that we are looking at are climate tech, defense, AI, and any deep tech with very real-world applications. And that's the idea. And with that perspective in mind, venture capitalism is what we are looking at. So it's going to be a VC fund focused on very early stage startups, which are doing some core fundamental work in this area.
I mean, maybe that's a good introductory line then to distinguish. I mean, many come from the traditional venture capital space, from the Web2 space, and I think there's a lot of distinct differences, especially to Web3 space. So if you say you also focus on, let's say, more Web2 traditional business models as early stage investments, but you also know the crypto side, what would be the key distinction? How would you explain to a venture capitalist who has not had exposure to the Web3 space, what are the most important factors for them to understand from your perspective?
So venture capitalists who are interested in investing in Web3?
It can be both. It can also be hedge fund, but or maybe to add more context, I mean, I would argue in the traditional Web2 venture capital world, there's this system of startup factory, where you kind of bounce from round to round, and each round goes with certain milestones, certain metrics. And in that context, I think and we will discuss about this a little bit more in detail, but let's say the traditional product market fit in Web2 space is you have a SaaS company and you make $1 million in revenue on an annual basis, and if you don't have that numbers to show for, you don't even need to reach out to a Series A investor. In the crypto space, this can look very differently when you raise a token model. Yeah. So maybe.
The crypto, and I've been kind of working in both areas. I come from core mechanical engineering, nuclear engineering kind of fundamental background, but I've gradually moved into the Web3 space, and it's kind of a strange world, right? When you come out with tokens, or you already are flush with funds, and being laser focused on innovation and making sure that you have good product market fit may not be that urgent a need when you have that kind of fund available. But in case of core deep tech, when you are doing work, say, on creating a new hydrogen fuel, for example, a rocket engine or something like that, you need to have very clear idea on what your development stages are, what kind of funds are required at certain stages, what your delivery schedule is going to look like, and how you're going to take it to production, because there is a lot of difference between creating a prototype and generating a technology and then taking it to production for mass adoption. Then there is also a thought that has to go in that, I have proven the technology, I have understood how the market dynamics works, and I'm taking it to market. But then there are logistic issues involved because you're now producing a real thing. How do you solve those logistic issues? Say, you may, as an example, just to take it forward, right? You may create a jet engine that is fueled by hydrogen, but now the hydrogen economics has to work, and the supply chain for hydrogen needs to build, and needs to be built up to various points where it needs to be adopted. So those are the issues. Those are very hardcore economic issues that one needs to really deep dive into, and that's challenging as compared to a world where you're coming out with layer 1 or a layer 2 on top of something which is already existing. I think the challenges in deep tech are very real, and the fund flow doesn't happen as early as it happens in Web3. I think that's That's one clear distinction that happens in my mind.
Yeah, if I could just comment on that. I think when Web2 investors looking to enter the Web3 space, I think the obvious comment is everything is different. It's highly volatile, but I'd like to sort of highlight one aspect, one of many, which is time to profitability. If you look at traditional Web2 tech businesses, take Palantir, take an Uber, take a Robinhood. Palantir took 19 years to become profitable, great business, but quite capital intensive. Uber, I think, took 10 years, and Robinhood about 8 years. And we, with the fund, we invest in early stage businesses that have a token that becomes liquid maybe 2-3 years post inception. So it's kind of like the business is doing an IPO, not maybe 5, 10, 15 years like a traditional SaaS business would, but 2 years basically. And these businesses, whilst the risk profile is very different. In traditional tech, you're worried about financing. These businesses need to raise money over multiple rounds. Hopefully, it's an up round every time. With Web3, you have a business that may do 1 or 2 raises, and then they can achieve break even or profitability within 2 to 3 year time frame. So from a financial standpoint, they are heavily de-risked. Obviously, there are other risks, technological risk and smart contract risk. These things can be hacked, and it's still very experimental. So I think the set of risk parameters is is very different. Comparing Web 2 to Web 3, and I think the time to profitability is something that when investors are looking at this space need to sort of better understand, because the network effects and the operating leverage that a Web 3 protocol, a business that is built on the blockchain, can achieve is second to none, and is basically it can't be done in an off-chain, if that makes sense.
Well, my advice for Web 2 people going into Web 3 is does that dog look cute? Then buy it. But jokes aside, I guess for the founder perspective as well, I would definitely say that the nature of investing in token versus stocks or equity is very different, because equity, at least the principles, is that you are investing in it because of the dividends that would pay through the profitability of the company, right? But in the case of token, that's not really the case, because there's no, well, first of all, it's not securities, right? I mean, depends on who you ask, but it's really not about the dividends or the profitability of the organization, but more like the demand that product is able to generate, the traction that it has, the momentum, so many different variables. So it opens up a whole new opportunity. So I would also say, like, to add on to your point, like it's looking at a different perspective. It's not replacing anything. It's not better than equity or anything. It's just another way to look at businesses and traction.
So if we stick to analogy, of a Series A company needs to show for at least $1 million ARR, otherwise don't even show up at the door of the Series A investor in the Web 2 space. What would be a comparable analogy to that in the Web 3 space for Series A, and is there one? Vineet, what are your thoughts on that?
Again, just getting from the points which were mentioned earlier, I think in Web 2 space, someone comes up with an idea and goes and scams his mommy, papi, dad and gets some money out, makes a presentation, goes to an angel investor, does $100 revenue, does a Series A, does $1 million Series B, and 8 years later, after hundreds of thousands of users using their product, it takes an IPO. This is how real world works, because these people have either booked a cab from you or gotten some food from you. While in crypto, in 1 month you have a seed round done, in 2 months you have a private round done, maybe there's no product at all still, and you have an IDO in 6 months. In a bull run, it's within 1 month. So basically you are shortening the period of 8 years into 6 months. So
without a product.
Yeah, so this whole thing he's been discussing with me about product market fit. My question to people here is, 4% of the world population, 400, if you see crypto.com report, 400 million wallets. That is if I assume 1% is one wallet, 4% of world's population is in crypto. 90% have no clue what Bitcoin is, what Ethereum is. They're just buying green candles. They have neither lent, neither borrowed, neither booked anything over there on crypto. Less than 1% of the world's population is in there. Where is the users right now? Users will come in 2030. The founders who are real right now, like I've been talking to Vijay from BitsCrunch, they need to build their treasury for 2030. They need, if their annual burn rate is $5 million, they need to get $60 million USDT in their reserves. Because in 2030, when 15% of the world population is there, they are the next Googles and they are the next Facebooks of the world. Right now, it's just probably 5-10 million users at the moment.
So still in the 90s of the internet.com era.
Yeah, we're starting up. And understand, we have companies which within 3 months of launching are sitting at $18 billion. Do you know how much effort, blood, sweat it takes to even make a single $1 billion company? And I don't want to name any companies. I've invested in them, but they're sitting at 18 billion market cap in less than 3 months of launch.
In respect of time, I would say let's wrap it up with a final question for each of you. Short statement, please. If you look back the last 2 years, what were your, so to speak, biggest, like if you want to talk about it, your biggest failures from investment standpoint, doesn't need to be your personal life, and your biggest learnings resulting from that you would try to avoid in the future?
I think for me, it's been a learning experience. There's no failures. I met a lot of amazing people in the last 2 years. Everyone, there was this term, tourist VCs, people who come in the bull run. We went against it. We actually went out and met everyone, had great conversations without expectations. And I think we are in the best space available, a growing asset class. In 2030, people in this room will be known for what they've been doing right now.
Yeah, I think for me, especially in the last 2 years, the bear market we just came out of, my background is in TradFi, so I try where possible to sort of apply, best practices in TradFi and when it comes to, evaluating tokens and projects and valuation. And I think, coming from TradFi, we like fundamentals, right? And I think my learning was over the last 2 years in a bear market, nobody gives a shit about fundamentals. And the market is basically extremely opportunistic and narrative driven, right? And I think the goal for an investor in this space is to sort of be able to match, narrative and fundamentals, and then you're probably, you're looking good. But I think, longer term, as this space matures, as it becomes more institutionalized, people will start to value some of these assets like you would value, equities or other, traditional assets. But, we're not, some of that's happening and some of that has yet to happen. And I think, keeping a bearing on sort of, narrative, the VC storytelling, plus, followed by fundamentals is probably a good thing to do in this market.
I guess I can go next then.
Yeah, of course.
So the founder perspective. So, I guess I'll just use this platform to have a slight self-plug in that we're going into seed rounding process right now. We're raising for funds. So if you're interested in what we're doing, I'd love to talk more. And this is where I guess the mistake part will also come in because while I was working with Sota to create Astar, we did have a lot of mistakes early on, especially when it comes to fundraising, because we started the company in Japan. In Tokyo, the goal was to be listed in the Tokyo stock exchange market. So they have an IPO, not an ICO. But for a crypto market, especially in Japan at the time, 2019, that was a big mistake because Japan is, they were really backwards when it comes to crypto and everything. And now the narrative is different, as we saw from the previous panels as well. Japan and Asia is like, they changed their national strategy because one of the reasons is because of Astar. When we were quite successful in Europe, especially in the dev field, we found out that, we could use this as a case to go back to Japan and say that, hey, you guys are losing a lot of talent. So understanding which jurisdiction, which country makes sense for your business model and find the right investors who are able to really support you and give you advice on that kind of stuff. I think that was really important learning lesson for us.
I have a core belief that innovation happens in constraints and when your resources are strained. I think last 2 years kind of proved that at a personal level, as well as when I look at the larger perspective, that I find that the downturn is important to shake up the boat a little bit and get the crap out of the deck. I think that happened and that was good. I also realized that it's at a personal level, it's probably better to have one foot in Web3 and 1 foot in Web2. So I think that made sense as well. And I think from Agna Foundation's perspective, I realized that there is understanding that deep tech and core engineering are the foundations, and you need to build on that foundation. I think Web3 is one application of that, deep tech technology, and we need not forget that, and we can't isolate it from overall use. Like when you take even Web3 technology to actual users, and as Vineet was saying, when 5% or 10% of the population, world's population starts using it, it's kind of solving some core problem for the users. And I think that's important to understand, that in that case, that has to be based on a very sound in an engineering foundation and business sense.
All right, great. Thanks for...
Wolf told me not to use the F word or the S word or anything, so I was very nice today. Normally I'm... Is that true, right?
Thanks a lot, Vineet. Yes. $10, yes. So thanks for sharing your insights. If anyone wants to get to know these gentlemen and learn more about their funds, then we have a networking session for the next hour. Thanks to everyone.
Thank you, everyone.
That's
Thank you.